Hi, this is Alan House. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Sharif Abdul and Charlie Moran. We here at Value Line hope you and your family are staying safe and dealing with this difficult time as best as possible. Today we're going to provide an update on the economic environment and the stock market. We will also discuss the actions Value Line is taking to help our subscribers navigate this still challenging time. We will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. Inflation remains elevated and has shown minimal signs of easing. This was evident in the September reports on producer and consumer prices. Indeed, the producer and consumer price indexes rose 8.5% and 8.2% year over year, respectively. The most troubling aspect was that core prices, which exclude the more volatile food and energy components, remained elevated for both measures. Likewise, the latest consumer sentiment reading from the University of Michigan showed that expectations for inflation over the next year rose to 5.1% from September's 12-month low of 4.7%. The recent decision by the Organization of the Petroleum Exporting Countries, OPEC, and its allies to cut crude oil production will likely add to the global inflation problem. Reducing daily global oil production, especially as the peak winter heating season commences, will probably push oil prices and gas prices even higher. This will make the cost of running a business and maintaining a home more expensive and put additional pressure on business and consumer spending budgets. Consumer purchasing power is shrinking as costs continue to climb. The latest inflation and jobs data give the Federal Reserve no reason to pause on the monetary policy tightening front. The expectation is that the central bank will hike the benchmark short-term interest rate by 0.75% to a range of 3.75 to 4 at its November Federal Open Market Committee meeting, which would be the fourth consecutive aggressive increase. The higher lending rates, which recently saw the rate of the average 30-year fixed mortgage jump above 7%, are weighing on the housing and home building sectors. Meanwhile, third quarter earnings season is in full swing. This will provide a good reading on how corporate America is doing and what effect inflation is having on businesses. The reporting season got off to a mixed start, with most of the big banks beating expectations on their net interest income gains fueled by higher lending rates. However, those same financial institutions cited mounting economic concerns as they look out into 2023. In conclusion, in an environment where the central bank is aggressively tightening monetary policy, which slows economic growth, we continue to recommend that investors focus on the stocks of high-quality companies that have the financial wherewithal to weather any potential economic downturn. I want to highlight that last sentence. I think it's worth saying again. In an environment where the central bank is aggressively tightening monetary policy, which slows economic growth, we continue to recommend that investors focus on stocks of high-quality companies that have the financial wherewithal to weather any potential economic downturn. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will show you now how to access it. Once signed in, head to the dashboard, which I believe is where Sharif is. This is the main landing page for subscribers. Under the quick links, click on supplementary reports, please, Sharif. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some companies incurred a lot of debt or sold stocks to improve liquidity over the last 2 years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those who don't know, financial strength along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, which is a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section on our website. Lastly, this is a good time to mention that the case for individual stocks is quite compelling over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during and after the current economic headwinds have run their course. Okay, now we're going to shift gears and go to the stock screener. So we're going to go move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Okay, so since market conditions are fluid, especially now, and long-term visibility is clouded, we're going to focus on equities that are relatively inexpensive relative to the broader market. First, we'll scroll down to the valuation ratios section of our screening criteria. The first screen we're applying is current PE ratio. We are looking for stocks that have a current PE ratio of 15 and below. In other words, we're looking for equities that are less expensive than the broader market. There are roughly 5,700 stocks in our coverage universe. And by applying just this one screen, we've already cut that down to about 1,319 stocks. So we've substantially narrowed the list of candidates. Now we're going to go to the ranks and ratings section. The next thing we're applying is a safety rank. There are loads of risk measures out there that Value Line offers, and we're going to start with our time-tested safety ranks. The safety rank measures the total risk of a stock, and it's arranged on an easy-to-understand 1 to 5 scale, with 1 being the most conservative issues. I want to highlight this fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from the investment education section of our website. For this screen, we're going to focus on stocks ranked at least 2 for safety. They are the largest, more stable equities under our coverage universe. So we're going to do stocks ranked 1 and 2 for safety, and that's going to cut our list to 139 names. So we went from 1,319 down to 139 names. Okay, although it's already a factor in the calculation for safety, I'm going to double down and include financial strength. These grades range from C to A double plus in 9 increments. We're going to go with companies that garner a financial strength score of A or better. We believe that this is another metric that is worthy of attention given the current economic climate. Following this screen, we have pared our list down to 53 names. The next screen we're going to look at is the technical rank. We are looking for stocks ranked 2 or better. While Value Line uses many fundamental indicators, we believe a look on the technical side is worthy of consideration. After running this screen, we have whittled the list down even further. We're down to 14 names. Finally, looking under the company data section, we will now focus on companies with 18-month appreciation potential of at least 25%. We're going to do 25%. So following that screen, we're down to 6 names. You can make a strong argument for any of the 6 remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now. And after consulting with a number of my senior analysts, we prefer and recommend Kroger, ticker KR. Before Sharif clicks on Kroger, please note that the screens can be saved and revisited by utilizing the Created Save Screen button on the top. Right where Sharif showed. Yep, right there. So you can save screens as you do them. Now let's click on Kroger and get some additional information from Value Line's digital report. The Kroger company is the nation's largest grocery store operator by sales, with about 2,725 supermarkets. The big news of late is the mid-October announcement that it intends to join forces with Albertsons in a deal worth north of $24 billion. We believe that the deal could have broader ramifications for the grocery store industry. Combined, the two companies employ more than 700,000 people across 5,000 stores. We're now going to look at our last full-page report on Kroger, which was published in mid-October, just a couple weeks ago. As you can see in the statistical array, or the center of the report that includes financial data, Kroger performed very well over the last couple of years with annual earnings gains that exceed the value line average. The Kroger company has been generating healthy sales growth. Revenues climbed 9.3% year over year in the August interim. Nearly half of the increase was attributed to fuel sales, which surged 41.5% on a 47.6% increase in gasoline prices. Meanwhile, identical sales, excluding fuel, were up nearly 6%, with higher prices along with an increased number of customer visits driving the advance. Private label sales were particularly strong, climbing north of 10%, as customers combated inflationary pressures by opting for lower-priced Kroger brands. Taking a look at some quantitative metrics, the stock has solid marks across the board. As we mentioned, the stock has a safety rank of 2, a financial strength rating of A. The price stability is 80 out of 100. This company's earnings predictability is 85 out of 100. The issue is also favorably ranked for technical indicators, 2, and its 18-month appreciation potential, as noted earlier, is above 25%. Also, we think that Kroger is poised for strong results in 2022 and beyond, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. I will now take your questions. Please note that we can't typically answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few questions were submitted prior to our presentation. Now I'll hand it off to Sharif and Charlie. Thank you.
Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line. And while Alan was talking, I saw some questions related to, in general, the new growth rates of larger stocks within the technology sector. And although it doesn't relate to Kroger, I thought that subscribers or investors should know that there are no kind of overall uniform growth rates that we apply to an industry. Each of the analysts has their own judgment or applies their own judgment to specific stocks. So when someone asks a question, as in this case, what is the decelerating growth of the larger technology stocks, which you could argue aren't necessarily correlated in terms of their various businesses. It's not a top-down assessment of Google, Amazon, and Microsoft. Each of the analysts have their own inputs into, the various things that go into the projections from a competitive point of view, earnings, sales, and whatever growth rates. The other question I had was from someone related to the actual sales and earnings projections in the wake of the possibility of the merger with Kroger. That is a really good question because as a policy, we do not finalize our projections, we do not incorporate the effects of a merger or divestiture until these things become finalized. So when something is announced and it's pending, that will not be reflected in the numbers that you see on the Value Line page typically. Obviously, well, in this case, there probably is going to be some issues regarding labor, or the DOJ will have to make some type of recommendations. So you will not see numbers reflected until the deal is actually finalized. Although sometimes I should mention that somebody might quantitatively say that, there'll be some type of accretion from an earnings perspective, or the proposed sale or acquisition will contribute a certain amount of sales. But apart from that, again, that's the standard policy that we have. Sharif, have you seen any questions that you could comment on? We haven't seen many this time.
Hey, Charlie, I just saw one. This is Alan. I saw one that came up that was pretty interesting. They were asking about the 18-month appreciation potential, and this is a this is a metric that Value Line started a few years ago. We've always been known for a time-tested, timeless ranking system, and we've always had 3 to 5 year, projections. But the 18 months kind of those looking with an intermediate term horizon. So we definitely have put focus on that as well. And none of these metrics exist in a vacuum. They're all interrelated to an extent, So I think when looking at investment possibilities, it's good to look at all three of those metrics. But the 18-month is certainly something we're focusing on now, especially given the current, economic conditions. Thank you.
We just got another question from someone, Mark Brown, who just asks a basic question regarding the price to earnings ratio at the top of the page. He asked if that is a forward multiple, and it is actually one that is, it uses a 6 months forward and a 6 months trailing earnings number, which is sort of uncommon now, but typically people are doing a 12-month or a 12-month past or a 12-month forward earnings estimate, but it's our convention to take the future 2 quarters as well as the trailing 2 quarters and use that as the earnings. Mark Fleming just asked about the relative PE last fiscal year and defining that. If you could maybe take the cursor there to 0.6 in 2021. Again, that's for their 2021 year. That is the relative PE ratio. The absolute PE ratio is 10.9, and that reflects the average price during the course of the year for Kroger divided by the earnings per share for the year, which was 3.68. So that would get you the average annual PE ratio, and the relative PE ratio is the PE, the absolute PE, in this case 10.9, divided by the overall PE ratio for the Value Line universe. And that equates to about 3/5 of the average. And if you see historically, I think relative PE ratio is actually one of the more informative pieces of information that investors can use to get a sense of how stocks are valued from a historical basis. You can see that it's never traded at a premium to the market, Kroger, and in fact has, the prior year got down to a little less than half of the market multiple at 0.48 in 2020, but it has gone as high as 0.9 and in the 80s. And if you look out 3 to 5 years, the analyst for a relative P ratio, if you could scroll over there, Sharif is using 0.8, and that is going to get you an absolute multiple of 14. So the 3 to 5 year multiple is going to be in the mid to high teens, and you get a 14 absolute multiple from which we get the target price range, multiplying the 14 times the 4.60 earnings per share projection in 2025, 2027. Let's see. I haven't seen other questions. Sharif, Alan?
Thank you, Charlie. I'm looking at, there's one related to the balance sheet, and if Sharif can go to the balance sheet, please, the current position or the cap structure, I should say. If you notice that the company is fairly highly leveraged, it's 56% debt to capital ratio. which, compared to, I guess, other industrial companies, a little bit on the high side. But for this particular industry, it's probably in the ballpark of other, of other grocery store operators. There's very high barriers to entry to this industry. It's very, capital intensive. There's a lot of investment that goes into it. Obviously, the grocery stores themselves are, a big investment as well as the products, et cetera, and obviously the staffing. So, I think for this particular stock, it's 56% is probably pretty moderate. As you can see by the cash position, the current position, the cash, the stock, the company has over $1 billion in cash on the ledger. It's a very strong financial company, even with the debt level. Like I said, you have to look, just like the PE ratio, you have to look at the balance sheet also on an apples-to-apples basis, which is basically comparing it to its peers. So I just wanted to comment on, the balance sheet considerations. Thanks.
Okay, one final question from Joe. He asked about if we could display the final, or the 6 stocks listed from which you chose Kroger. I don't know if you can do that. From memory, I remember 4 being Avnet, Pfizer, AIZ, which is Assurant, and SEI Corporation. I forget the 5th, but those were the 4. And I guess I'm going to send it back to Brandon. There are no more questions.